Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to another edition of What is Driving the Markets, where we discuss key events and address key questions on investors' mind. In today's episode, we discuss the implications of RBI's monetary policy meeting. In its December meeting, the Monetary Policy Committee of RBI voted 5:1 in favor of raising the policy repo rate by 35 basis points to 6.25%. Consequently, the standing deposit facility rate stands adjusted to 6% and the marginal standing facility rate and the bank rate stand adjusted to 6.5%. The Monetary Policy Committee also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within target going forward while supporting growth. On growth and inflation forecasts, the RBI lowered its growth projection for fiscal year 2023, citing accentuated headwinds from protracted geopolitical tensions, tightening global financial conditions, and slowing external demand. Gross domestic product is forecasted to grow at 6.8% in fiscal year 23, with third quarter growth at 4.4% and fourth quarter growth at 4.2% respectively. RBI retained its inflation forecast for fiscal year 23, which was kept unchanged at 6.7%, with third quarter average inflation forecasted at 6.6% and fourth quarter average inflation forecasted at 5.9%, with risks evenly balanced. Average CPI inflation for first quarter of fiscal year 24 is projected at 5%, and second quarter average inflation is forecasted at 5.4% on the assumption of a normal monsoon. Other key takeaways from the monetary policy are as follows. First key takeaway is on RBI's view on growth and inflation dynamics. RBI noted the resilience of domestic macro fundamentals and highlighted that the economy was stable and has sufficient buffers to weather challenges from the external environment. However, the RBI's inflation projection of an uneven road to normalcy, pegging second quarter fiscal year 24 inflation at 5.4%, indicates that it remains mindful of the challenges ahead. The RBI governor reiterated that Monetary Policy Committee is of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break the persistence of core inflation, and contain second-round effects so as to strengthen medium-term growth prospects. The second takeaway was on the liquidity conditions. The RBI governor noted that overall system liquidity remained in surplus. During October and November, the average total absorption under the liquidity adjusted facility was INR 1.4 trillion, down from the average 2.2 trillion during August and September of 2022. However, the RBI governor cautioned market participants to wean themselves away from the overhang of liquidity surpluses as an indication of gradual moderation in system liquidity over the medium term. Having said that, the RBI also stated its readiness to act on both-sided liquidity operation and smoothen the volatility if it arises. The third key takeaway was on RBI's acknowledgement of the role of external factors in determining further policy action. While noting the resilience of the Indian economy, the RBI indicated other external developments like the global growth slowdown, geopolitical tensions, trends in commodity prices, and central bank policy rate action will continue to influence domestic policy direction. In our view, the RBI's policy actions were broadly in line with consensus expectations of a 35 basis points rate hike. However, the decision to remain focused on withdrawal of accommodation was contrary to markets' expectation. Bond yields rose across the curve following the policy announcement. Now, what does this mean for investors? In our view, bond yields appear to have another leg up in the near term, driven by the following factors. 1. Falling bond yield differential with its global peers as central banks stay hawkish. 2. Worsening government bond demand and supply dynamics amid an expansionary fiscal policy and muted institutional investor demand. And 3. Bond yields likely pricing in only a part of the expected policy rate hikes by the RBI. Bond yields have remained range-bound despite the overnight index swap spread suggesting further rate action by the RBI going ahead. Overall, bonds continue to remain a core or neutral holding. We retain our preference for short maturity bonds over medium to long maturity bonds, given better risk reward at shorter maturity yield and lower sensitivity to rising interest rates. At this point, I'll take a pause and thank you as always for listening. If you find this podcast useful, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.